Let's learn about stocks. Have you ever wondered how people own a piece of big companies like the toy store where you buy your favorite action figures, or the place where your parents get their coffee? Well, sometimes, they own a tiny bit of those companies through something called stocks. It's like having a very, very small slice of a giant pizza. What is a stock? Imagine your class wants to start a lemonade stand. To buy all the lemons, sugar, and cups, everyone needs to chip in some money. Let's say 10 students each give $10. Now, instead of just having the money, you decide to divide the ownership of the lemonade stand into 10 equal parts, called shares. Each student gets one share. A stock is very similar. A big company, like the one that makes your video games, needs money to grow. So, it divides its ownership into many, many tiny shares. People can buy these shares, and when they do, they become part owners of the company. It's like having a tiny piece of that video game company. Why do companies sell stocks? Why would a company sell parts of itself? Well, think about our lemonade stand again. If you wanted to buy a bigger, better stand, or maybe add cookies to sell, you'd need more money, right? Companies are the same. They might want to build a new factory, create a new product, or hire more people. To get the money for these things, they can sell stocks. It's a way for them to raise money without borrowing it from a bank. When people buy the stocks, they give the company money, and in return, they get a share of ownership. The stock market, a giant marketplace now, where do people buy and sell these stocks? It happens in a place called the stock market. Think of it like a huge, bustling marketplace, like a farmer's market, but instead of fruits and vegetables, people are buying and selling tiny pieces of companies. There are different stock markets in the world. Some famous ones are the New York Stock Exchange, NYSE, and the Nasdaq. These are like giant, organized places, though a lot of it happens on computers now, where buyers and sellers meet. Prices on the screen. What do they mean? When you look at a screen showing stock prices, it might seem like a bunch of confusing numbers. But it's actually quite simple. Each number represents the price of one share of a company's stock. Let's say you see Apple AAPL, $150. This means that one share of Apple stock costs $150. If you wanted to buy 10 shares, it would cost you 10x $150 equals $1,500. The prices change all the time. They go up and down, kind of like the waves in the ocean. This change in price is why people buy and sell stocks. They hope to buy them when the price is low and sell them later when the price is higher, making a profit. Why do stock prices change? You might be wondering, why do stock prices go up and down? There are many reasons, but here are a few simple ones. Company performance. If a company is doing really well, selling lots of products, making lots of money, more people want to own a piece of it, so the price of its stock goes up. It's like if our lemonade stand became super popular, and everyone wanted a share. News. Good news about a company, like discovering a new invention, can make the stock price go up. Bad news, like a product recall, can make the price go down. Overall economy. The general health of the economy can also affect stock prices. If the economy is doing well, most stock prices tend to go up. If the economy is struggling, they might go down. Supply and demand, like anything else, the price of a stock is determined by how many people want to buy it, demand, and how many people want to sell it, supply. If lots of people want to buy a stock, the price goes up. If lots of people want to sell it, the price goes down. Imagine a popular toy. If everyone wants that toy for their birthday, the store might raise the price because so many people want it. If the toy isn't very popular, the store might lower the price to try and sell it. What does buy low, sell high mean? The basic idea behind investing in stocks is to buy low, sell high. It's a simple phrase, but it's very important. Buy low, this means buying shares of a company when the price is relatively low. You're getting a good deal, like buying a toy on sale. Sell high, this means selling those same shares later when the price has gone up. You're selling it for more money than you paid for it, and that difference is your profit. Imagine you bought a share of our lemonade stand for $10. Later, the lemonade stand becomes super famous, and people are willing to pay $20 for a share. If you sell your share then, you make a profit of $10. 20 to $10 equals $10. What is going long, or buying long? When people talk about going long, or buying long, on a stock, it's a fancy way of saying they are buying a stock because they believe its price will go up in the future. They are optimistic about the company or the overall market. It's like saying, I'm buying this company's stock because I think they will make great products, and their stock price will go up. You're long on the stock, hoping for a positive outcome. You are betting the price will go up. What is short selling, or going short? Short selling, or going short, is a bit more complicated, and it's like betting that a stock's price will go down. It's a way to try to make money when you think a company might not do so well. Here's a simplified example. Borrowing shares, you borrow a share of a company's stock from someone else, like borrowing a book from a friend. Selling shares, you immediately sell that borrowed share in the market for, say, $50. Price goes down, you hope the price of the stock goes down. Let's say it drops to $30. Buying back shares, you buy back a share of the same stock in the market for $30. Returning shares, you return the share to the person you borrowed it from. Profit, you made a profit of $20. You sold it for $50 and bought it back for $30. It's like borrowing a toy, selling it, and then buying the same toy back when it's cheaper. You then return the toy, and you keep the extra money. Important note about short selling can be risky. If the stock price goes up instead of down, you could lose a lot of money. In our example, if the stock price went up to $70, you would have to buy it back for $70, losing $20. $70 to $50 equals $20. There is no limit to how high a stock price can go, so potential losses are unlimited. Day trading. Some people try to buy and sell stocks very quickly, sometimes within the same day. This is called day trading. Day traders try to take advantage of small price changes that happen throughout the day. It's a bit like trying to catch tiny waves in the ocean. It can be exciting, but it's also very risky and requires a lot of attention and knowledge. Most experts advise against day trading for beginners. Investing for the long term. Many people invest in stocks for the long term. This means they buy stocks and hold on to them for many years, sometimes even decades. They believe that over time, good companies will grow, and their stock prices will go up. It's like planting a seed and watching it grow into a big tree over many years. You don't expect it to grow overnight, but you believe it will grow strong and tall over time. Diversification. Don't put all your eggs in one basket. A smart thing to do when investing is diversification. This means spreading your money across different stocks or different types of investments. Imagine you have 10 eggs. Would you put them all in one basket? If you drop that basket, all your eggs will break. But if you put a few eggs in several different baskets, even if one basket falls, you still have some eggs left. Diversification is like having different baskets for your money. If one company's stock doesn't do well, you still have other investments that might do well. This helps to reduce risk. Conclusion. The world of stocks can seem complicated at first, but it's really about understanding how companies grow and how people can share in that growth. Remember the lemonade stand, the toy store, and the different ways prices can change. And always remember the important idea of buy low, sell high.